This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast.
Okay, let's dive in. There's this legal tool, almost hidden sometimes, that's really driving huge parts of global finance, big international deals, fund finance. It's often underpinned by one specific type of agreement from Luxembourg.
That's absolutely right. The Luxembourg Pledge Agreement. If you're involved in cross-border lending, secured finance, you simply have to understand it. It's not just an option, it's very often the preferred one.
And we've got some great source material here, really digging into this pledge and the law behind it, the Law of 5, August 2005. Yeah, and our mission today really is to unpack all that. Cut through the legal jargon, explain why it's so popular, why lenders love it, and pull out the key insights from these sources.
We want you to walk away understanding why this is called the linchpin of secured financing. We'll cover where the law came from, how it works for different assets, and crucially, how it holds up when things get tough, like in insolvency.
So the starting point has to be that law. The Law of 5, August 2005. It's really a cornerstone of Luxembourg's financial center status.
Right, but it didn't just appear out of nowhere. It came from EU initiatives, I understand.
Correct. It started with transposing the EU's Financial Collateral Directive. That was 2002/47 EC. But, and this is key from the sources, Luxembourg didn't just copy-paste. They took what's called a maximization approach.
Maximization approach. Okay, what did that actually involve? What did they do?
Well, essentially, they used all the flexibility the directive allowed to create a system that is exceptionally creditor-friendly, very efficient. It was a deliberate move to make Luxembourg the go-to place for these kinds of deals.
Okay, so what makes it so attractive? What are those core features?
The sources point to three main pillars. First, contractual freedom. Parties get a huge amount of leeway in how they structure the agreement. And crucially, they define the enforcement event, the trigger for the lender's rights.
So it's not just about missing a payment. It can be broader.
Much broader. It could be breaching a covenant, a change in financial condition. Whatever the parties agree is a risk indicator. Gives lenders flexibility. Second pillar, legal certainty.
Meaning it's predictable.
Exactly. The law is clear, the courts uphold it consistently, lenders know where they stand. That reliability is huge. And third,
efficiency.
Efficiency. It's built for speed, especially when enforcing the security. You can generally enforce it out of court. No need for lengthy, costly judicial processes in most cases.
Avoiding court, that sounds like a massive plus for lenders facing a potential default.
Oh, absolutely. Saves time, money, uncertainty, and the law's reach is broad, too. In terms of who it applies to, ratiae and personae, it covers banks, financial institutions, insurers, funds, companies. Quite a wide net.
And it simplifies things by calling them all commercial acts.
Yeah, that just brings them under more flexible commercial law rules. And then what it applies to rationem materia, that's financial collateral arrangements, three main types mentioned.
Okay, what are those?
There's the pledge or gage, which is the main one we're focusing on. Then title transfer for security, transfert de propriété à titre de garantie, and repurchase agreements, mise en pension.
But the sources really emphasize the pledge, the gage.
Yes, that's described as the bedrock. It's overwhelmingly the most common tool used in practice under this law.
Okay, so we have this flexible, creditor-friendly law. Now, what exactly can you pledge under? What kind of assets are we talking about?
The scope is very broad. The law talks about assets, which basically means financial instruments and claims or créances.
Financial instruments, that's the usual suspects. Shares, bonds.
Precisely. Shares, bonds, fund units, money market instruments, all that stuff. And what's really important, the sources stress this, is it applies regardless of the form. Physical paper, electronic entry, registered bearer, doesn't matter. And also crucially, irrespective of the governing law of the instrument itself. So you could have German shares or UK bonds pledged under Luxembourg law. It cuts through a lot of potential conflicts.
Makes dealing with international portfolios much simpler, I imagine.
Definitely. Then you have claims, créances, rights to payment. Think intercompany loans, trade debts, and here's where it gets really, really important for the fund world.
I think I know where this is going. Capital commitments.
You got it.
Yeah.
The law explicitly covers claims against fund investors for their uncalled capital commitments. This single point has made the Luxembourg Pledge absolutely vital for subscription line financing globally. It's huge.
Wow. And another big plus mentioned is pledging future assets.
Yes. This is a major flexibility. You can grant security over, say, all present and future receivables of a certain type.
So assets the borrower doesn't even own yet.
Correct. Or claims that haven't arisen yet. You don't need a new pledge agreement. Every time a new asset comes into the pool, it creates a sort of floating pledge, very practical for things like revolving credit lines.
And Luxembourg isn't just resting on its laurels here. The legislature keeps updating this law.
Absolutely. They're actively making sure it stays relevant. For example, a law in 2022, July 20th specifically, clarified that pledges over claims from insurance policies are definitely covered.
Okay, makes sense. What about newer things like digital assets?
Address that too. Law of March 22nd, 2023. It explicitly included instruments issued on distributed ledger technology, DLT, think tokenized securities, under the definition of financial instruments.
So they're staying ahead of the curve.
Seems that way. It sends a strong signal to the market. Luxembourg is committed to adapting, providing certainty even as finance evolves. That gives international players a lot of confidence.
Right, that confidence must be key. Okay, let's get into the weeds of the agreement itself. The pledge agreement. How do you actually create one and make it stick, make it perfected?
Good question. So, creation and perfection. First step, it has to be in writing.
Including electronic.
Yes, electronic form counts. The main thing is clearly identifying the assets. If it's claims, just listing them is generally enough proof against others.
Okay, and the sources talk about dispossession. Sounds a bit old-fashioned, like handing something over physically.
Well, yeah, the term comes from older laws, but the 2005 law gives it a modern meaning. It's not usually about physical transfer anymore. It means the pledge, or usually their agent, gets control over the asset. How you get that control, that depends on the asset type.
And this works well for big syndicated loans, lots of lenders involved.
Oh, absolutely crucial for that. The law specifically allows the pledge to be granted to a single security agent or trustee, acting for all the lenders, even future ones who might join later.
So you don't need those complex parallel debt structures you see elsewhere.
Exactly. It avoids that legal workaround. The agent structure is clean and recognized directly under Luxembourg law. Very efficient.
Okay, let's walk through how perfection actually works for a few key assets, based on the sources, registered shares.
Right. For registered shares, so shares listed in the company's own shareholder register, you perfect by actually recording the pledge in that register. And you notify the company, which usually acknowledges the pledge, by signing the agreement too.
Okay, what about bank accounts? Cash.
There, you need to notify the bank holding the account. And you absolutely need the bank's acknowledgement. Critically, you also need the bank to waive any rights they might have over the account, like liens or set-off rights. Get that waiver.
Right, clears the way for the pledge and for receivables or claims, like those capital commitments again.
Here's an interesting point. The pledge is actually valid and perfected between the pledger and pledge just by signing the written agreement.
Really? You don't have to tell the underlying debtor, the person who owes the money.
Not for validity between the main parties, no. But, and this is a big but, market practice is always to notify the debtor.
Why is that, if it's already valid?
Because until the debtor knows about the pledge, they can still legally pay the original creditor, the pledger, and be off the hook. Notifying them redirects the payment obligation. It ensures that, especially upon enforcement, the money flows to the pledgee or the agent.
Got it. Locks in the payment flow. And briefly, securities held electronically, like in a brokerage account.
Those are book entry securities. Perfection there is all about showing the pledgee's control over the account or the securities, usually done via control agreements with the custodian or specific ways of registering the pledge in the relevant clearing system. Depends on the setup. Now, let's quickly look inside the agreement. What are the main clauses you'd expect to see?
The sources give a good breakdown. Starts with the preamble and definitions, setting the scene.
Exactly. Identifies who's who, links to the main loan or bond deal. Two crucial definitions. Secured obligations, always drafted super broadly to cover everything owed now and in the future, principal, interest, fees, costs. And pledged assets, defined very carefully, making sure to include proceeds like dividends or interest.
Then the core part, the granting clause.
Yep, that's the formal bit where the pledger says, I hereby grant a first priority pledge over these assets to secure those obligations.
And you've got the usual representations and warranties.
Standard stuff.
Yeah.
Pledger confirms facts. They own the assets, have the right to pledge, no other liens exist, etc. It's mainly about allocating risk if those facts turn out wrong.
Followed by covenants, the ongoing promises.
Right. Things like promising not to pledge the assets to anyone else, a negative pledge, not to sell them, and to do whatever's needed to keep the pledge perfected in first place. Protects the value.
What about things like voting rights on shares or receiving dividends? Who gets those?
Typically, the pledger keeps those day-to-day rights while the loan is performing. But, and this is a big but, the agreement will state that upon an enforcement event, those rights automatically flip over to the pledgee or the security agent.
Ah, so that's how lenders can potentially take control of the underlying company whose shares are pledged.
Precisely. It's a key strategic right. Might be more valuable than just selling the shares immediately. And then the clause that gets the most negotiation.
The enforcement clause.
The trigger.
The absolute heart of it for the lender. Defines the enforcement event. Remember, contractual freedom means it can be almost anything agreed, not just payment default. And it lays out the pledgee's powerful options: appropriation, private sale, public sale.
And crucially, usually without needing prior notice or court involvement.
That's the default under the law, unless the parties specifically agree otherwise in the contract. It brings us right back to that efficiency point.
Makes sense. Then you'll have clauses on the waterfall, how enforcement money gets applied, and the release conditions when the pledge terminates, usually upon full repayment. And finally, governing law and jurisdiction.
Which is almost always specified as Luxembourg law and Luxembourg city courts for that certainty factor. So let's talk about that enforcement. When a trigger event happens, this is where the law really shows its teeth, right? Designed for speed.
Exactly. That's the payoff for creditors. The flexibility in defining the enforcement event itself is a major plus. Lenders can set triggers to act early if things start looking shaky, not just wait for a missed payment.
And the lack of prior notice or court sign-off requirements.
Again, unless the contract adds them back in, the law removes those hurdles. Realization is a private matter between the parties based on their agreement. No judge needed to okay the sale.
Can you quickly recap the main methods? Appropriation, private sale, public sale?
Sure. Appropriation is where the pledgee effectively takes ownership of the asset. Very common for shares. Lender becomes the new owner, gets control of the company. Private sale is selling the assets privately, but it has to be on commercially reasonable conditions. Requires careful handling. Public sale is more formal, via auction by a notary or bailiff, or increasingly selling on a trading platform.
If the lender just takes the assets, appropriates them, how do they figure out the value? Seems open to issues.
That's a critical point. The law says the value must be determined using the method agreed in the pledge agreement. Typically, this means getting an independent expert valuation. The sources emphasize it's very hard to challenge this valuation unless there's obvious error or fraud.
So, while getting that valuation might introduce a bit of a delay.
It does. That's the main time factor in enforcement. The sources estimate maybe 6 to 10 weeks, perhaps longer, for a proper valuation. But once that's done, the actual transfer sale can happen very quickly compared to court processes elsewhere.
Okay, now for what many see as the superpower of this whole system, the insolvency remote shield.
Absolutely. This is paramount for international finance. The 2005 law is incredibly clear. The pledge stays valid and fully enforceable, even if the pledger goes into insolvency. Liquidation, reorganization, doesn't matter the type or country.
So the pledged assets don't just get thrown into the pot for all creditors?
Nope. They are ring-fenced, kept separate solely for the benefit of that secured creditor, the pledgee. And crucially, the normal insolvency rules that let administrators claw back transactions made just before bankruptcy, those suspect period rules. The 2005 law explicitly says they do not apply to these pledges, barring actual fraud.
That must provide enormous comfort to lenders, especially dealing with counterparties in, let's say, less stable jurisdictions.
Removes a massive layer of risk and uncertainty. And we saw just how important this protection is and how committed Luxembourg is to it very recently, didn't we?
Right. The sources detailed that whole drama in 2024. It got quite tense for a bit.
It really did.
Yeah.
A huge moment. In January 2024, the Luxembourg Court of Appeal issued a ruling that, well, frankly, shocked the market. It suggested the insolvency protection might only work against bankruptcies within the European Economic Area, the EEA.
Which would gut its value for any deal touching the US, UK, Asia, basically most international finance.
Exactly. Massive shockwaves. Huge uncertainty for countless deals. The perceived global shield seems suddenly limited. But the reaction, it was incredibly fast.
The government stepped in quickly.
Remarkably fast. By July 2024, Parliament had passed a new law, explicitly clarifying that, yes, the insolvency protection works worldwide, regardless of where the bankruptcy proceedings happen. They stressed this was always the intention.
And then the final word came from the top court.
Yes. In December 2024, the Supreme Court confirmed it. They ruled that even under the original wording of the 2005 law, the protection was intended to be global.
So what's the takeaway from that whole episode?
It's a powerful signal, really. Shows Luxembourg's absolute commitment to legal certainty for its financial sector. When a court ruling caused major disruption, the lawmakers acted decisively, and the highest court ultimately backed the market's long-held understanding. Huge reassurance for global creditors.
Okay, fascinating stuff. Let's look at how this pledge gets used in more sophisticated setups. The sources mention the Double Luxco structure quite a bit.
Ah, yes, the Double Luxco. A classic technique, especially in big leveraged buyouts, LBOs, or high-yield bond deals, where the actual operating businesses are scattered across different countries.
And the point of having two Luxembourg companies in the chain, why not just one?
It's all about creating an enforcement point that's safely firewalled within Luxembourg's legal system. You want to isolate the key enforcement step away from potentially difficult foreign insolvency regimes. Think places with automatic stays like the French Sauvegarde, or where there's a risk the company's main base, its co-MI, could shift unexpectedly.
So the Double Luxco is like building a legal safe room for enforcement.
That's a good way to put it. You typically insert two Luxembourg holding companies, let's call them Luxco 1 and Luxco 2, between the ultimate parent, often outside Lux, and the operating company, OpCo, somewhere else. Luxco 1 owns Luxco 2. And Luxco 2 owns the OpCo group.
And the absolutely critical pledge is
a pledge granted by Luxco 1 over the shares it holds in Luxco 2. And that pledge agreement is governed by the 2005 law.
Great. So if things go wrong, lenders enforce that pledge in Luxembourg.
Precisely. They use the swift Luxembourg process, maybe appropriate the shares of Luxco 2. Boom, they now control Luxco 2 and therefore everything underneath it, including the OpCo, all without getting bogged down in potentially messy court fights or insolvency rules in the OpCo's home country.
And the double part using two Luxcos is essential because
it ensures the key pledge, the 1 over Luxco 2 shares, is between two Luxembourg entities. If you only had one Luxco, its shares might be owned by a foreign parent. Enforcing that pledge could bring foreign law back into the picture, undermining the whole point. The Double Luxco anchors a crucial enforcement step firmly in Luxembourg.
Adds complexity, cost for substance, sure, but you can see why it's done for major cross-border deals.
Exactly. The security benefits outweigh the structuring effort for those large, complex transactions.
What are the typical sticking points when negotiating these pledge agreements?
Well, you see the natural tension. Lenders always push for, the broadest possible definitions of what's secured, what assets are covered, strong covenants, and really flexible enforcement triggers that let them act early.
And borrowers?
They'll try to narrow the scope, limit the promises they have to make, negotiate cure periods time to fix a breach before enforcement, and push for very clear, fair valuation methods if appropriation is on the table. Thanks to contractual freedom, these points are highly negotiable.
What about costs and timing overall?
Costs are generally competitive, mostly legal fees. A big advantage is usually no stamp duty or expensive public registration fees are needed for perfection, unlike some places. Creation is quick, tied to the main deal timeline. Enforcement, as we said, has that valuation step, maybe 6 to 10 weeks or more, but the actual execution after that is fast.
Looking ahead, the sources mentioned AIFMD2. Any impact?
Yes, the expectation is that the updated Alternative Investment Fund Managers Directive, AIFMD2, will likely lead to more loan originating funds setting up in Luxembourg. That should naturally increase the use of Luxembourg pledges, especially in fund finance, for securing loan portfolios.
Makes sense. Any other forward-looking points? Tax?
The sources briefly touch on tax, noting it can be complex and needs careful planning. For instance, if collateral doesn't cover the full debt, the debtor might face tax on the forgiven amount. A pledge-selling assets might face capital gains. So tax advice is crucial around enforcement.
And the main recommendations coming out of the sources for lenders and borrowers?
For lenders, really use that contractual freedom on triggers. Consider structures like the Double Luxco for cross-border deals and be absolutely meticulous about perfecting the pledge correctly for every asset type. Dot the I's, cross the T's.
And for borrowers,
focus on negotiating fair valuation methods, reasonable cure periods for non-payment defaults, and fully understand how enforcement impacts control, especially voting rights. Know what you're giving up.
Okay, so wrapping this up, it seems clear the Luxembourg Pledge, powered by that 2005 law, really is a cornerstone of international finance. That mix of flexibility, certainty, speed, and especially the robust insolvency shield, it's quite a package.
It absolutely is. It's a framework that's been deliberately designed, stress-tested by events like the 2024 challenge, and consistently refined to meet the needs of a very demanding global market.
So here's a final thought for you, our listener. Considering how Luxembourg deliberately designed this incredibly creditor-friendly system, and how quickly it acted to protect its global reach when challenged, what does that signal about the different balances struck around the world between making international finance efficient and protecting borrowers when things go wrong? Something to ponder. This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.